In this video, let's take a look at my top 6 international equity ETFs for foreign markets exposure. Instead of playing hide and seek, here they are. There's no particular order to them. My goal for this video is not to just skim through them, but dig into each one and understand their pros and cons. And stay to the end of the video. I will talk about which fund works best under what scenarios. And so hopefully this will help you decide which international equity ETF suits your needs best. Here's the summary info for them. I want to draw your attention to a few things. First, IDVO is the only active fund. All other funds are passive index ETFs. IDVO is also the most expensive one with 0.66% expense ratio, but it has the highest yield thanks to that cover call overlay we will talk about in a second. Also, all 6 ETFs have the biggest exposure to the financial sector. Most of this exposure comes from Japan. In fact, Japan has the highest exposure among all funds except for IDVO. As you know, tech companies dominate the US stock market, but in foreign markets it's a different matter. Financial companies play a bigger role there. Finally, this list has a mixture of value, blend, and growth funds. Value tends to perform better than growth in foreign markets, surprisingly. But this performance rivalry between them rotates from time to time. The first fund is BNY Mellon International Equity ETF, or BKIE. BKIE has one of the lowest rock-bottom expense ratios of all funds on our list, and that's something to like. The fund is managed by the Bank of New York Mellon. It's a well-established financial institution known for its custody and trust services. BNY Mellon is a relative newcomer to the ETF business since 2020. BKIE focuses on developed markets equities only. The fund tracks the performance of the SCHF index. SCHF is a German financial company specializing in creating stock indices. BKIE's portfolio construction is straightforward. The fund considers developed market countries listed here. After liquidity filters, BKIE weights its holdings by free float market cap. I searched for any caps or limits on sector or stock allocations and didn't find any. Limits and caps are probably not a concern for this fund, given a wide net it casts over many markets. BKIE does nothing special. It doesn't filter stocks based on their yield, financial metrics, or anything else. It may seem like it's boring, but it's very simple and effective approach. BKIE will give you a very broad exposure to foreign markets at a very low fee. Weighting holdings by their market cap ensures that BKIE will go where the markets go, and most of its portfolio resides in large cap stocks, as well as about 10% in mid cap stocks. So BKIE will perform in line with a typical foreign large blend fund focusing on developed markets. If we look at sector allocations for BKIE, they are very close to a typical foreign large blend fund. As far as country distribution, over half exposure is in developed Europe and the UK. The remainder is concentrated in Japan and Canada. Canada alone has close to 12% allocation. One thing about BKIE is that it doesn't consider South Korea a developed country. Thus, the fund excludes this country. This can create some divergence in its returns. As expected, emerging markets are missing, and that could be a negative depending on your preferences. Developing markets underperformed developed equities in the last 5 years, but on a historical basis, emerging markets did much better. Although these better returns came with a lot of volatility and large drawdowns. At the end, it will depend on your view on developed versus emerging markets performance. And right now, a typical large foreign large blend fund allocates about 8% to emerging markets. But this percentage is not really set in stone. Back in 2020, a typical foreign large blend invested close to 20% of its assets in emerging markets. So in that sense, if emerging markets shine again, BKIE will lag some of its average peers. And that's something to keep in mind for any fund on my list that doesn't invest in emerging markets. The next fund on my list is FNDF by Schwab. This ETF comes at a reasonable expense ratio of 0.25% with a focus on developed markets. Now, this fund takes a whole different approach to constructing its portfolio. As you may know, most funds select and weight their holdings by market capitalization. The larger the market cap of a stock is, the more allocation the stock receives and vice versa. Funds following the S&P 500 or Nasdaq 100 are prime examples of market cap weighted index funds. In 2005, Arnaud and others published a research paper. There they challenged this accepted idea of market cap weighting superiority. They laid out arguments in favor of weighting stocks based on fundamentals. Fundamentals included things like a company's sales, dividends, income, and book value. The concern with market cap weighting is that it's too volatile to measure a company's true size or fair market value. For instance, take Nvidia back in 2022. At its peak in 2021, Nvidia stock price hit $33 a share, but in 2022 it plunged to $11 per share, which is over 60% decline. Later, as everyone knows, Nvidia went on an epic rally, increasing 15-fold since that bottom. The question we should ask ourselves is this: what really changed fundamentally in 2022 that warranted this huge drawdown? In hindsight, probably little changed. It was super beneficial to go overweight on Nvidia back then when it hit that rock bottom. But if you used market cap weighting, you wouldn't do so. In fact, market cap weighting often overweights overvalued stocks and underweights the undervalued ones. Now, that's a very bold statement. Authors compared their fundamental weighting approach to the S&P 500 performance. They found that fundamental weighting showed superior returns. The result held true on a volatility-adjusted basis too. This research paper is the basis for FNDF. FNDF uses a company's sales adjusted for leverage, cash flows, and payouts to rank stocks. The higher any of these metrics are, the bigger the weight of a company is. After ranking stocks based on these metrics, FNDF drops the bottom 2% and selects stocks in the top 87.5%. The fund has a 5% cap on individual stocks. All this gives FNDF a more contrarian flavor. The fund prioritizes stocks with lower valuations as we see here. Basically, FNDF goes after fundamental mean reversion. In other words, it often buys stocks with lower valuation in hope that they revert to their mean. Very often, FNDF buys low and sells high when mean reversion happens. Also, by its design, FNDF may include certain growth names too. This small sliver of growth has given FNDF an edge over its peers in foreign large value category too. When it comes to sector allocations, FNDF allocates less to the financial sector by about 8%. But as far as other sectors, they're not too different. The fund tilts towards stocks from Japan and the UK. All in all, this is a very different take on value investing that I rarely see among passive index funds. The third fund on my list is IDVO by Amplify. The fund comes with a somewhat higher expense ratio of 0.66%. The fund considers stocks from all corners of emerging and developed markets. Its top 10 concentration is at 35% with only 74 holdings in its portfolio. IDVO also uses cover call option overlay to generate extra income. In fact, its yield is the highest among my 6 international ETFs. About 60% of IDVO's yield comes from real dividends. The remaining 40% is from cover call premiums. As you may know, cover calls generate that income, but they cap the upside of the fund. The good thing about IDVO is that it doesn't go that heavy on cover calls. In fact, if we look at its holdings, we see that there are 57 stocks in its portfolio, but the fund wrote call options only on 11 of them. On top of it, the written call options do not cover their entire stock positions. So, very likely its portfolio coverage from sold options is very low. This allows the fund to take part in rallies with no material constraints. Also, cover calls can provide a small cushion in drawdown episodes, although it's probably immaterial. Now, the biggest drawback of this ETF is that it's an active fund, and active funds tend to underperform passive ones over long periods of time. But it could be different for IDVO. But either way, this fund looks like a black box to me from outside. We have no idea how its managers select securities. IDVO says that it selects securities based on their cash flows and earnings, among other things. Looking at Morningstar factor decomposition, here's what we see. It looks like IDVO buys stocks showing a lot of momentum. In other words, it tends to buy equities with higher price appreciation lately, relative to peers. I would say that it's probably the biggest selection criterion for IDVO. All other factors like quality, growth, and value tend to jump around. I made a video on momentum investing and SPMO ETF linked here, and from that we know that momentum investing works. So this is to IDVO's advantage. But we know also that momentum investing can enter periods of underperformance. But either way, IDVO's selection process is a secret, and that's a wild card to me. The fund is somewhat overweight on energy and communication stocks at this time. Financial services companies occupy the largest exposure of 20%. Alibaba and TSMC are two largest allocations for the fund now. So far, IDVO showed impressive growth in its yield on cost. It grew by over 50% in a matter of 3 years. Its future distribution growth will depend on price appreciation of its portfolio. If foreign stocks enter a bear market, drawdowns will cause smaller cover call premiums. Under this scenario, IDVO's yield may drop. The fourth fund on my list is SCHF. The fund comes at the lowest expense ratio of 0.03% and tracks developed markets only. SCHF filters stocks by liquidity and sorts them by market capitalization. Eventually, the fund invests in the top 99%, and that's it. In this respect, SCHF is very similar to BKIE ETF. It provides a broad, diversified exposure to developed markets, weighted by market cap. SCHF has about 1,500 stocks in its portfolio. BKIE and SCHF returns have been more or less a mirror image of each other. The main difference between these two funds is exposure to South Korea. As we saw, BKIE excludes South Korea for some peculiar reason, while SCHF includes it. South Korea exposure is around 5% in SCHF's portfolio. The two biggest holdings are Samsung and SK Hynix, which are both technology stocks. This can contribute to some divergence in returns between these two funds. The fifth fund is VYMI by Vanguard. VYMI has a focus on high dividend stocks from both emerging and developed markets. It comes with an expense ratio of 0.17% and a yield of 3.9%. The fund uses a very simple but effective approach to maximizing yield. VYMI's main requirement is that the stock must pay dividends in the next year. But other than this rule, anything goes. VYMI sorts stocks based on their expected yield, and those that land in the top 50% by yield will go into VYMI's portfolio. The fund holds over 1,600 stocks in its portfolio on a given day. One drawback with going heavy on yield is concentration in the financial sector. It stands at over 40%. This will be there by design for VYMI. Most high-yielding foreign stocks are banks and other financial institutions. If foreign banks underperform, they will take VYMI down too. That's something VYMI's investors must be comfortable with. Also, VYMI has a sizable allocation to emerging markets with 18%. That's the highest emerging market allocation among my 6 ETFs. As a dividend fund, VYMI showed strong yield on cost growth, but it dropped big time after the COVID. While the recovery has been uneven, distribution growth is back on track again. And the final 6th fund on my list is VIGI, also by Vanguard. The fund charges 0.1% fee and invests in both developed and emerging markets. VIGI focuses on high-quality companies with dividends from developed and developing countries. VIGI's main screen is the history of growing dividend payments over the last 7 years. If a given stock misses even one payout, it will have to wait another 7 years. Then VIGI sorts stocks based on their yield and then takes a haircut by eliminating the top 25% stocks. The goal of this haircut is to get rid of value traps. After that, all the remaining stocks are weighted by their market cap with a 4% exposure limit. Market cap weighting helps steer the fund towards more stable and large cap companies. But amazingly, many of these dividend-paying stocks also have growth characteristics, but they tend to be more defensive in their nature. In fact, VIGI is the only fund on my list classified as foreign large growth by Morningstar. VIGI has over 360 stocks in its portfolio. Most of them reside in the financials, industrial, and healthcare sectors. Its biggest country allocations are Japan, Canada, and Switzerland. Its emerging market allocation stands at 7%, coming from Indian and Chinese stocks. Next, let's compare total returns for all 6 funds. Since 2022, the biggest winner is IDVO ETF. Its outperformance is material. Likely, a lot of it has to do how its momentum stocks did very well since then. But look at VIGI. It turned out to be a bottom dweller. In fact, if we zoom out on a 3, 5, or even 10-year time horizon, VIGI has consistently underperformed its peers. The main reason has to do with VIGI tilt to growth stocks. Value tends to perform better than growth in foreign markets, as we saw before. This has been especially pronounced since 2020. Value stocks in the financial and energy sectors rallied, and a lot has to do with rising inflation and interest rates. But if foreign growth stocks shine again, VIGI may catch up. VYMI and FNDF have consistently outperformed other funds. This again goes back to their heavy tilt to value factor. At the same time, blend funds like BKIE and SCHF performed a bit worse but on par with each other. Their focus on a mix of growth and value was at play here. If we compare volatility-adjusted returns, here's what we see. IDVO stands out the most on a 3-year time horizon, with its above-average returns. But FNDF was not too far behind, which is impressive. Looking at the 5-year horizon, IDVO drops out, but VYMI shines here. Again, its heavy tilt to value was behind its impressive performance. FNDF was not too far behind, but its high volatility made its Sharpe ratio worse. So let's summarize what we have seen so far and conclude which fund works best under what scenarios. The first thing to decide is whether you believe in growth or value in foreign markets. If you believe foreign value will do better, then FNDF and VYMI are your best choices. FNDF has a contrarian approach to selecting stocks based on fundamentals. BKIE and SCHF take a middle ground by being blend funds. They take advantage of the best from both value and growth. VIGI is a growth fund, so it will not be the best performer in this case. As far as IDVO, it's a wild card as it jumps around growth and value a lot. However, IDVO is best if you would like to pursue momentum factor, that is, investing in stocks that showed relatively better recent price appreciation. Momentum investing works long term, but it may enter periods of underperformance here and there. Also consider whether you want or not exposure to emerging markets. As we saw, some funds on my list focus exclusively on developed markets only. When it comes to yield, IDVO also shines. This is thanks to that cover call overlay for income. VYMI is the second best. VYMI will most likely continue showing strong distribution growth. As for IDVO, it will depend on whether its portfolio continues appreciating. When it comes to transparency for portfolio construction, unfortunately IDVO scores low here. Its active approach, which is a black box, is a detraction here. We don't know what IDVO does and can only make educated guesses about it. As for diversification and concentrations, VYMI, VIGI, and IDVO look less attractive. The sector or top 10 concentrations are heavy. This may or may not be important to you though. On a final note, Morningstar does have medalist ratings for all 6 funds. VIGI is the only ETF that earned gold rating. Note that these ratings are for funds relative to their peers in respective investment categories. For VIGI, it is within foreign large growth category, and so on. Morningstar uses a combination of parent, process, and people pillars for that. The rating ranges from negative to gold and signals a chance for a given fund to outperform its peers within a specific category. We see that IDVO earned the lowest rating of them all. This has largely to do with the company behind this fund as well as its active approach. Morningstar tends to dislike funds with an active approach. They also don't like ETFs with a parent that has not shown a proven track record with its funds. This may change though. And that's all I have for today. I hope this video gave you insight and you'll choose the best ETF to suit your needs. And also let me know in the comments down below which fund you personally like most. If you'd like to learn more about momentum investing and SPMO ETF, check out my analysis linked here. Also like and subscribe to my channel for more insights on investing. I will see you at the next one. All the best!